Something isn't adding up. Inflation is high, interest rates are high, everybody is worried about a recession, tech companies are laying off people, and despite all of that, the Nasdaq is only 10% away from its all-time high. Apple, for example, is already at an all-time high. Microsoft is very close to it. Nvidia is breaking new records, and Meta, Facebook has made 200% gains in the last weeks. Wall Street pretty much forgot all the disaster around VR, all that burned money for the Oculus Quest. What is going on here? Property demand is super low because financing a house nowadays is unaffordable due to the high interest rates. The consumer is getting squeezed because salaries don't rise as quickly as inflation. And in the official numbers, it already becomes apparent that Europe itself, or Europe as a whole, is in a recession. Where does all this money come from that increases those prices? To me, it looks pretty short-term speculative money. It's not a general monetary expansion. The Fed is rather further contracting the monetary supply, which would then in the end lead to the idea that those could be artificially propped up prices. The way stock valuations work is the following. The value of the stock in its fundamental idea is the sum of all of the company's future cash flows. So the company makes profit every year, and then parts of their profit gets paid out to dividends, so to the shareholders, and all of the dividends that you expect to receive in the future, adding all of those up and discounting them by the interest rate. That's the value of a stock. When you increase interest rates, you have to discount those further cash flows more. So in other words, rising interest rates is bad for stocks. It's also bad for bonds. When we now see that the stock market is at very similar levels in terms of US dollars compared to the end of 2021 when interest rates were still low, this implies one of two things. Either the stock market thinks that the profits in the future of tech companies will be way bigger than 2 years before expected, because you have to discount them more now, right? So the profits themselves, they might be way larger than what we thought 2 years ago. Or alternatively, the stock market thinks that maybe interest rates at some point will be coming down again. Falling interest rates are not really priced into the bond market, so I really don't have a good explanation where this is coming from. It's incredibly hard to time the stock market. There are so many professionals out there, so many quants, so many people that do nothing else their whole day than valuing equities. But if you're considering to get into the stock market besides just buying index ETFs, if you're buying individual stocks, then I think it's important to always look at the relative valuation. Because when you buy a single stock, you take on idiosyncratic risk, right? So you don't know, will this company really outperform in the future? And so you diversify, right? You rather buy 20 stocks than just one. But when you do this, you're actually more than likely to underperform the index. And that's because profits are very much concentrated in a small number of companies within a certain sector. So you might have seen this, for example, with the phone market, right? Most of the profits in the smartphone market go to Apple, and you see this in other sectors as well. And so you've got a few outliers that maybe do double or triple the return, and then you've got the broad masses that actually do worse than the average, because the average gets pulled up by those outliers. So when you simply just diversify across 10 or 20 more or less random stocks, it's more likely than not that you're not going to pick those outliers. But still, if you're considering to buy individual stocks, always measure them against the index. So let's say you look at Facebook, right? This looks like a fine stock to buy over the long term, right? It went up by 600%. Now it's recovering again. So what's the problem? Problem is, once you look at this relative to the Nasdaq, and you have to do this, right? This is your opportunity cost. You should only get into idiosyncratic risk if you expect outperformance. Why else take on that risk? This is Facebook divided by the Nasdaq. And this looks way less of a consistent outperformance, right? Only 20% in the last 11 years or so. You can do this relatively straightforwardly. You just go here to TradingView and then you enter, for example, Meta and then /NDX. And then you press enter. That's the way how you get those charts. And I look at any stock that I individually purchase in that way. So that's why I would also not touch Amazon, for example, right? Amazon looks nice, but once you look at Amazon relative to the Nasdaq, the outperformance is pretty much not there, at least for the last 7 years or so, right? This is also how we can evaluate, for example, the performance of Warren Buffett. How good is Warren Buffett actually doing while the economy is shifting to digital ways of trading? Let's look at this. Here we've got Berkshire shares, but this time not in US dollars, but divided by the S&P 500. A very long-term chart. This is actually the entire chart. It starts in 1979. And there was a time when Berkshire outperformed the general stock market really, really nicely. 5,600%. But again, for the last 15 years, there was no outperformance. This looks pretty much like random fluctuation to me. So this is what matters in any investment. Measure the asset relative to its benchmark. Measure the altcoin relative to Bitcoin. Measure the stock relative to the Nasdaq or to the S&P 500. Consider opportunity cost. Investing is a game of taking the right option. You've got capital, you want to pick the best option, and the option is not, am I in cash or am I invested? If you have long enough of a time horizon, you don't want to be in cash. The question is simply just, what's the best fluctuating investment option for this particular part in the portfolio? And for that, you have to make relative valuation charts. You have to compare the performance. And for most stocks, you will see an underperformance. 80% of the stocks underperform. Very few of stocks outperform the index. They outperform then massively. They move up the entire index. So the average performance is way higher than the median performance. If you found this useful, please give this a like and feel free to subscribe as well.